Today on Resource Talks, a mining engineer seems to have gotten bored with the summer doldrums because of all people in the world. He's chosen to talk to me for the next hour or so, and he's talking to me about mining economics and specifically what makes a good ore body. More specifically, how to recognize a good ore body in an MRE or a PEA, or even before all of that, and be able to position yourself into the decent projects that will actually eventually come out of the ground instead of keep on giving money to people who know that they're sitting on stuff that are never coming out of the ground, but of course are not going to tell you about that. Just briefly for people watching or listening, if you want a summary of this conversation and all the other interviews that we do on Resource Talks, go to resourcetalks.com. There's a free newsletter. It goes out once a week with a bullet point summary of all the conversations from the week before. The mining engineer I'm talking about is Neil Ringdahl, your next door mining engineer, if you will. Follow him on Twitter and watch my previous conversation with him from about 6 months ago. But the gist of it is that he's a friendly South mining engineer. You might want to coin that there, Neil. But he's a friendly South African mining engineer, decades of experience in building and running mines, fourth generation of miners, and his daughter is a mining engineer as well. So I guess that gives him a lot of credentials. And I am not doing too much justice with that intro there, Neil, but it's probably time for me to shut up already and let you do the talking. So thank you for being here today.
No worries. Good to see you again.
Pleasure is mine because we're dissecting one of your Twitter threads again, essentially. And this one is about resource modeling. And I think it makes sense maybe to talk about why companies even put out a resource in the first place. What does that really tell investors? Like, does it add any material value than just simply reading the assay tables? Why do they even do that?
Well, of course, it's worth it. I mean, the whole idea of a MRE is to find something, what the economic value is of whatever asset is that's being reported on.
Mm-hmm.
So yeah, of course it's important. And then I guess the MRE, with the standard either JORC or 43101 type report is a standardized report where, where the authorities have tried to put enough rules together to basically standardize the reporting as much as possible so that you can compare resource A with resource B, okay? Or, opportunity A versus opportunity B, which is kind of difficult because individually each one's unique and each one has their own problems and their own upsides and so on. So it's very difficult to quantify it. But I guess the only way to do it is to declare a resource, and the resource really is how much metal is in the ground that's economically extractable, and that helps most investors who don't really have a clue about mining understand what the potential economics could be. So I think it is very valuable. Yeah.
What the potential economics could be is actually an important sentence, especially said that way, because I think a lot of retail investors see an MRE as this is what this mine is going to be worth, but it's very far from that, right? And I suppose in your experience, what percentage of the MREs that you encounter are realistically economically mineable?
Well, by definition, most of them are, because if they're not, they can't be reported as an MRE. How many MREs get turned into mines? That's a good question. I guess it's the same as how many, exploration companies become mining companies. Very few. But as resources become more and more scarce, lower grade resources that were previously uneconomic become economic with time. So I guess it's probably fair to say that a lot of them will eventually become a mine, but whether they become a mine in our lifetime is another story. Okay. And to say how many, I don't know, but it's probably very few because of the timeline taken to build a mine. You've got to permit it, you've got to do more drilling, you've got to turn the MRE into a mineral reserve rather than a mineral resource estimate, which is a lot more constraints, and put a feasibility together. And then even then your feasibility economics may not be that good and project gets shelved, or for other external reasons, social reasons, political reasons, or other reasons, maybe company is not well managed, or there's some drama that happens at a corporate level, or a strategy change, these mines just won't get built, or these resources won't get built into a mine.
Well, I think to your point that by definition it is realistically feasible. I think a lot of the things get turned and twisted and smeared and so on and so forth that we can talk about. And I do want to talk about how companies actually achieve that, because I think most of them are actually not realistic that I see. But when do you think is the right time for companies to issue an MRE in the first place? And in your opinion, specifically, because I know there's a lot of this disagreement about that out there. Like, do they need to have have done a certain amount of drilling or conversion or met work or something else, or is it mostly market and cycles dependent?
No, I think it's definitely more about how much drilling you've done. Also, I think it's worth pointing out that these estimates normally they have to be done by an independent party, unless you're an operating issuer that's got a well-established track record and large. You have to go external, and you have to have an independent, qualified person or persons or company actually produce a report, and they have a reputation themselves to protect. So that protects the investor, and that's the whole idea about the guidelines and the regulations for putting together one of these for public companies. That protects a lot of people. So coming back to your question, at what point? Well, if you have one drill hole or two or three drill holes, it's obviously not enough information for you to put together a resource, even if you have grading sections. You need to have enough there to at least define something of economic value. A lot of that depends on the shape, the size, the type of mineral deposit. So it is very subjective, very hard to kind of generalize, an answer for you on that one. But I would say if I was a junior explore co out there, greenfields, you go out there and you scratch around, and you have your geologist find something that's interesting, and you do some surface sampling and you put those results out. Then maybe you scratch together enough money to start a drilling program. And if you can define something that can, have a decent life of mine, either something, because mine takes a lot of effort and capital to build, you need to be able to repay that capital. Normally, you need to have something 5 years or 6 years at least in operation. And then it's a scale of things. It comes back down to what is the value of the rock you're looking at. And if the value is high, so let's say I find a gold deposit and it's amazingly running at 30 grams a ton or an ounce per ton, it can be a very narrow vein. I could start a mine at 100 tons a day and make $20 million profit a year quite easily, okay, at that grade. And that doesn't require very much. So, I just need to define how well, if I'm going to build a mine that's 100 tons a day, that's super valuable, it's going to cost me a few $1,000,000, maybe $10 million to build a plant, a little gold plant. Let's assume it's a basic, it's a fairly small plant, maybe even less if it's gravity gold. And there's not a lot, if it's mostly gravity gold and there's not a lot of processing required or metallurgy to it, could be very cheap. And you could build a mine, inside 2 years, inside even a year, at 100 tons a day is pretty easy to get to. Low expectations. So I may only I might only have a mine life of 3 years, and I could get away with making $40 million over 3 years. Hell, it'd be worth it, right? So, but whether that will suit a, large, most of these junior companies want to generate large amounts of capital, relatively speaking. They're not looking at small scale mines. You're generally looking at something a little bit more volume, obviously a lot lower grade. And that's also something, if the grade's lower, you have to move more tons, which means you have to have more volumes. You need to drill more to define that volume. And so it's a balance of getting all of those right to decide when or what point do you need to go, and when does this thing become economic? Have a couple of good hits and decide, let's drill some more. All right, do we have enough here? If we tabulate this let's say it's a elongated deposit, and we know it's approximately this wide, and we have so many meters long, so many meters of depth. Define how many tons is that, and if we process it at say 1,000 tons a day, do we have enough to do to mill for 5 years or more, or even 3 years? And maybe it's worth putting in a MRE, and then you can raise more money on the back of that because it's at least it's a piece of paper you can hold in the air and wave around at potential investors and say, this is what we've got, and it's got it's open at depth and it's open on strike, and we'd like to raise more money to further define this and generate something that will be really exciting.
Mm.
Yes, that's what people will do. Yeah.
I think you have it wrong because you're almost approaching it as a real business, which obviously this is not what we're doing here. You're supposed to do it when it will have the most impact on your share price so that you can raise more money and keep the lights on for another year and do some marketing, right?
Yeah, I mean, I'm speaking from a mining engineering perspective, not necessarily a promoter perspective or an issuer's perspective. Okay.
Yeah.
If we've got a public company and I go and stake a property, I'm going to have to be promotional about it. And then anything that I can find on that property, well, let's promote it. Everyone's talking about lithium a couple of years ago. Suddenly, all these companies changed their names to lithium companies.
Yep.
They changed from zinc to lithium, and then now it's over to gold. Gold's a new thing. Lithium's off, nickel's off. But 10 years ago, everyone was talking nickel. You have a nickel project, very exciting, very exciting, right?
Hmm.
So yeah, I see where you're coming from. Probably looking at a lot of small companies, looking at trying to produce attract investors. It's better if they have a mineral resource estimate because it's something you can read and dissect and make your own mind up. Tons times grade times recovery times price, less your costs and your selling costs, gives you some kind of economic value, and you can get some kind of idea what the scale might be. May help you make it, or help me make a decision as a mining engineer whether I'm interested in it or not.
Mhm.
I wouldn't really be interested in the project unless I could do that number in my head based on the drill results, and I believe that there's a lot of potential, and they don't yet have a mineral resource estimate. That's how I look at it. I look at it from the economics because at the end of the day, smart investors always look at it from an economics point of view, and whether it's potentially building a mine. Then, those people who invest into explore coast in the hope that they're going to hit a blue sky, magnificent result. I think you might be better off going to a casino unless you're a geologist yourself and understand the geology.
Yeah.
And I'm saying with all respect to all the speculators out there, but it is a high risk business, right? And so you invest in a junior company. If a junior explore co, I'd be looking at the geologist doing the exploration program. I'd want to talk to them, probably over the CEO, and see what they say.
Mm.
If I could get to that person.
I was mostly I was mostly trying to be funny there when I said that that's how you should look at it, and that's exactly the reason why I want to talk to you about this because you're approaching it from again those decades of actually having operated these things, and that's what we're eventually after. So it's good that you're covering it that way. What happens when that MRE is out, though? What am I looking at? What's the first thing that I should be looking at when a company announces an MRE? I open it up. Am I looking at grade, tonnage? What am I looking at?
Yeah, I mean, a multitude of things because it's the first step towards de-risking an asset. Okay, so these reports have standard things. First of all, they talk about where it is, the infrastructure, the climate, and then it gets into the nitty-gritty, the drilling, the deposit type, and the drilling, the quality controls, and all the rest of it. So all of those chapters are important, and if I look at a company with one, the first thing I obviously would look is tons and grades, and generally I get turned off anything that's not that high grade right away because unless it's very substantial, because I just know building a low grade mine takes a lot more work and a lot more capital. And Well, people mocked me previously, when the famous, Vicuña project in Chile, when the first numbers came out, I was a little bit suspicious. The numbers seemed too good to be true. 1,000 meters at, what is it, 0.3% copper equivalent or whatever they have. It sounds crazy, and I was suspicious when I see some number like that. But that's an exception, right? And now, it's obviously going to be built as a massive, copper mine. But initially, I missed it because I was naturally suspicious because it was low grade, and I know building copper mines on the border, or back then, building a mine on the border with Argentina and Chile was difficult to do. Big companies have failed doing that.
Hmm.
So. So that to me that turns me off. I look for something that's easy to build. A good case would be Rio 2. I'm a shareholder, by the way. But Rio 2, and I'm not promoting it per se, other than I'm not. I just think they were a relatively easy mine to build. It's a relatively easy process. It's a fairly low grade mine, but it was a simple business case. And I took the numbers. What's the tons? What's the grade? Times the metal price, times the recovery. That's my revenue, less my potential costs. And then you look at the things like the risks, like, well, what about the water? It's a mine in the desert at altitude. Okay.
Yeah.
And if I'm comfortable with those risks, then I'll make a decision to maybe buy it or not. Okay. And you get that information from an MRE. You won't necessarily get all that information with drill results.
Yeah.
So that's the benefit of one.
How did you make that decision specifically for Rio, by the way, just for a second here? Because you're mentioning the water risk there, and I've interviewed Alex before, and we've talked about it before, but they're going to be trucking water, right? Which is one of the things that people pointed out as a risk. How did you know not to get? I suppose it comes down to experience, but how would I know not to get scared off, for example, from trucking water up a mountain?
Well, the things I would look as an operator, and what I did look at was, well, how many trucks of water will they need, first of all? Okay. And I can't remember the number. It was some years ago I did the calc, but it wasn't a ridiculous number. You didn't have to have 500 truckloads a day or something crazy. Okay. Because that's the first thing. It's got to make sense. And you've got to think about it from a social point of view because everybody along the road is going to be affected by trucks going past, right? So if there's a lot of trucks going past, that would be a red flag for me. So that was the first thing. The second thing is, well, what is the cost of trucking water? There's no difference really in trucking rock and water. The only difference is the solid, the solid or liquid, and there's a bit more abrasion in the rock, and you've got dust problems. But water is heavy. It's heavy like rock. So it's going to cost you a fair amount. And a rule of thumb number that I use is about 15 cents, maybe should be a little bit higher these days, but 15 cents per ton per kilometer. Okay. So I literally calculated how much water they mentioned they needed, how much water they need per day. Okay, they need to get X number of trucks. I think it was 15 trucks. 20, was it 20? Something like that. And per day of water, and a truck does 20 tons, and so how many you multiply that by the distance trucked, and can the same fleet, is it the same trucks going back and forth, or is it a larger fleet? Work out the cost, and yep, it's possible. It was possible, so that ticked off that one for me. So
Yeah.
they were reasonable assumptions. Okay. And the answers made sense. So, obviously there's a phase 2 in the project and all that, but I always want to look at the first phase of the project. Does the first phase work? No point in investing in something if phase 1 doesn't cover its costs. Okay, then something's been hidden, in that. I haven't seen a case like that, but it's got to make sense. And another thing that's often, you'll see where the MRE comes out, often a company's stock won't move. And I've been in that situation, having being an issuer, working for an issuer, we put out a what we think is a pretty good PEA, okay, preliminary economic assessment or a feasibility study. Nothing moves. The needle doesn't move. And he's like, what's going on? And that's because people are not accepting, they either don't know enough about the project or they do, and they don't believe you can execute for whatever reason. Okay. So I think a lot depends, if you see a feasibility or a PEA or a MRE come out and it's the nut and the stock jumps, then you very quickly get an idea if, and this is obviously a very good number, a very good result. It's a good project and it's likely to be built. If it doesn't move, there's still some risk. There's either it's financing risk, or there's some social risk, or there's some metallurgical risk, or there's something that somebody's picked up on, or someone knows. And there's a lot of very smart people in the business who follow these things in a lot more detail than I do. I'm busy with my own mining operations and stuff. I don't get to look at stocks as nearly as much detail as you do, for example, Antonio.
Mm-hmm.
Okay. And so I don't have the time for that. So I have to rely on, and like many other investors who don't have the skills I've got, you've got to rely on other people too. And so, yeah, it's not just the mineral resource estimate itself. It's also how does the stock react? What is the sentiment? And I'm always thinking from an operator point of view as well. So, it might not be a great resource estimate, but there could be a lot of upside in a thing. And the company may be wanting to just demonstrate that they have something at least and that they can grow it. That's not necessarily going to move the share price, but at least that's something that investor can take courage with if you want to take a risk and invest into a company so that they can fund more drilling or whatever it is to increase this, hit the big one.
If it's not going to double my position overnight, I don't want to hear it. That's also the approach. But you bring up a good point there, Neil, on grade, because you kind of brushed over it actually, saying, "Oh, I want it to be a grade that works." I find that companies are being too optimistic with cutoff grades oftentimes, because that's not something that a lot of us check. It's not something a lot of us understand in the first place.
Yeah.
How do you deal with that? How do you look at a cutoff grade and be like, no, this isn't, from a perspective of a non-technical person like myself?
Right. So the cutoff grade is the minimum grade at which you can mine a ton of rock without losing any money. Okay. That's the definition of a cutoff grade. So when you calculate that, you look at operating costs, any costs or sustaining capital costs, any cost that would stop if mining stops, theoretically. Okay. So when you do a resource estimate, generally you're a little bit more relaxed on the cutoff grade because you want to include mineral that potentially will be economic at a future date. Okay. I guess it's a leeway to be a little bit more optimistic. And, every company wants to portray their resource or their asset in the best possible light. So they're obviously going to want to choose a cutoff grade as low as possible. And you have the consultants pushing back saying, no, well, that's not realistic for you to assume a 20 cent per ton mining cost for an open pit mine. In this hard rock environment, for example, we won't accept such a low cost. So there is some balance, but it'll still be lower than what likely will be the final cost when you do a feasibility study. And I think that's fair because at the end of the day, you want to make sure all blocks that potentially have marginal economic value are included as well, because that can bring down your overall, bring down your overall cost, but it can change the dynamics of the project a little bit. Okay. It's kind of hard to explain. I guess it's not that hard to explain. It's just you got to think about why people use slightly lower, higher cutoff grades in defining resources. You want to include all blocks that could potentially be mined. So if you end up with a cloud of blocks in one particular area, your mining block, potential mining blocks, and they cut off grade, they fall below the cut off grade, you exclude that cloud completely. But if there's a large cloud that are on the limit, maybe with time you can do some more engineering to bring that cloud of blocks into a reserve by changing the mining method, or maybe looking at the processing method. Maybe, many companies start a mine like with leach tanks, and then they might say, oh, well, we've got this low grade stockpile here. What are we going to do with it? Why don't we heap leach it? Okay, so that low grade stockpile was built because it was below the cutoff grade, or that higher grade material that they could put in the plant instead. And so that material becomes an asset after a while. All right. Another good case, you have big mines. There's one in South Africa, a big copper mine called Palabora. Many, many years ago, they started as an open pit mine, and they built a huge stockpile of magnetite. I think it was magnetite. Anyway, it was something like that, that had no real value, but they built it in moving the waste out of the way. And now there's another business, or there was, I'm talking decades ago, but another business was built treating that magnetite and processing and reselling that magnetite. It wasn't an asset until it became an asset, until there was a heap of it stuff there. All right. And then you look at it, oh, wow, suddenly this is economically viable. So for that, taking that kind of way of thinking, I think having you've got to have something fairly realistic, not off the charts optimistic, but what would reasonably expected to be the mining costs and processing cost for something, and what would your reasonable expectation of recovery be? And if the grade times the price covers that cost, then it should be included as part of the resource, and let the mining engineers decide whether they can actually extract that material at a profit. Because most likely that stuff that's marginal in the resource falls out in the reserve when you calculate it into the reserve, with much more strict, much more better defined costs, and much better defined recoveries and dilution factors and recovery factors, and selling costs. All that stuff is defined a lot better when you go into a reserve from a resource. And so keep that in there, because if you exclude it, it may mean the mine doesn't actually get built until someone has another look at it again in the future and does a new MRE. That's possibly why people are a little bit more lax on these cut-off grades.
Is there a range where you want to see that ratio of inferred versus indicated and measured, for example, where you're like, I want...
Yeah, for sure. Measured? Because inferred is not, you can't actually include any inferred in any numbers, really. In a preliminary economic assessment, you're allowed up to 30%. I don't know if the rules have changed, but the last time I did one, you're allowed up to 30% inferred resource in the numbers, in your mine planning numbers. Okay. But a preliminary economic assessment, especially for a greenfields operation, is a bit dubious. You need to go to feasibility or pre-feasibility, and there definitely you're not allowed to include inferred material in the economics. Okay. So why you want to have indicated category resources and measured category resources, because there's a lot more confidence in the numbers, and it all comes down to interpretation. You drill two holes and you get two intersects that are the same, roughly the same thickness, and you're looking at, let's say, a tabular ore body. If those holes are close together and the ore body is flat and tabular, you have higher confidence, right? And you can do some geostatistics, and the geostatisticians will tell you, okay, they're close enough to have a high degree of confidence, so we can make it a measured category or indicated category. But as they get further and further apart, it becomes inferred. That's literally because we don't know if there's a bulge or if it shrinks between the two drill holes, right? And the same, in terms of the shape of the ore body. So your volume disappears, and your grade becomes more, your likelihood of hitting a similar grade in the hole in between these two, we don't know, because grades and tons are spatial, their spatial dimension. It's a spatial thing, and the grade is a function of the distance from what was sampled. That's how geostatistics works. It assumes everything is uniform, isotropic, and continuous. And in the real world, things are not isotropic and continuous, but we have to make some assumptions. And, it comes down to the detail. If you drill a hole, if you were able to drill the same hole the second time, would you get the same result? If it was possible, is your assay repeatable? Will you get exactly the same result? Now, assumption is yes when it comes to geostatistics. And then the argument is, well, if I drill a hole that overlaps another hole like that, okay, I should get very close relationship between the two results, right? Because there's overlapping portion. If they drill next to each other, the results will be very similar. We imagine that's the assumption made when you do geostatistics.
Mm-hmm.
But as you move further and further apart, your two drill holes, they have a less of an impact on each other, right? You have less confidence that the grades will be the same, and at some point it becomes too far apart, where there's no influence. And so that's how you should look at resources. When you see measured, hand on heart, it's there. If it's indicated, it's probably there. And if it's inferred, well, it's inferred. It's inferred that it's there. It's not necessarily economic, and you see that in the fine print at the bottom. But that's really what it means. It means there's a lower confidence. It's material that we have a low confidence is there. But it can be improved, and inferred material can be moved into measured and indicated categories simply by putting in a few more drill holes, and that can be converted. So often we look at converting. Mining operations convert a lot of inferred into measured and indicated category. And that obviously improves the robustness of the project when you do that. So as the project develops, sorry, I know you want to say something, but as the project develops, you go from early exploration, where you've got too few drill holes, too scattered to define something. And as you put more drill holes in, you start to define the shape of this thing, and you start to realize, okay, there's mineralized economic horizons that you can potentially be mined, and you can start to infer what's between them, right? And then as you further fill it in, you get more and more information, and you can put together, at some point you decide, all right, I'll put together a mineral resource estimate. And then normally, as the project progresses, drilling continues, and infill drilling continues to happen to firm up on those numbers. So I like to use inferred. When I do my desktop studies, I generally include inferred numbers to see what potentially a project could look like.
Mm-hmm.
Okay. But I always remember it's not necessarily going to be like that. So you hope for me, it's to calculate what I hope the project could be, and then I plan on what it will be based on measured and indicated.
Yeah.
Okay. Yeah.
I like how you made a mining engineer joke there with inferred, and then you laughed at it yourself.
Yeah,
that was a wholesome moment right there. I think that's that's like at least half the reason why I have you on here, and I will have you on again. What metallurgy is something that we should talk about as well, because it's sort of inferred indicated to tell you how much could you pull out of the ground. Metallurgy tells you how much of what you've pulled out of the ground can you actually sell in concentrate or doré or whatever it might be. Guidelines for metallurgy. Is there like a cutoff where you look at, if it's below 80%, I'm not looking at it, or anything like that?
No, I don't look at anything like that. I look at the number as a factor, a multiplier, the grade by, to reduce the recovered grade. Okay, so I can work out a lower price. But what I do look at is the mineralization. And this part can be sometimes a bit tedious to read in a report. You look at the mineralization, and you look at the deposit type. And if you know your stuff, it can tell you a lot about what to expect. All right. Certain projects, certain deposits have issues, with recovery. There's arsenics to consider in some copper projects. In VMS projects, you have problems. In some projects, you can't recover the metals that easily unless you grind very, very fine. These things come with experience, and if you do a lot of reading, you'll learn about it. Okay, there's some really good resources out there like 911 metallurgist is a good place to start. Okay. Um, and so if you go into it, there's a lot of work done on this stuff. And so if you're prepared to do the reading, you can become quite knowledgeable about this and it'll help you make your decisions. Because often what will happen, someone will look at it, you'll be given a recovery, but that is an estimate. And so I read the mineralogy, read the deposit type, and then I look at the metallurgical test work and I look at the recommendations in the test work section. Okay. And quite often there'll be a get out of jail clause in there put by the competent person, okay, to say, we recommend that the further work is done to recover the tin from this deposit, or we recommend that looking at recovering 3 concentrates is viable because, sometimes you get a polymetallic where there's copper, zinc, lead, and tin. I was looking at one fairly recently, and they want to produce concentrates and everything. Okay. And so they take, tons time, grade time recovery for each one. But the problem is some of those metals float out in the other concentrates and you don't get payabilities in those concentrates. All right. So so that's where metallurgy becomes important. Like, can I actually produce a saleable concentrate? It's no good if I produce a copper concentrate that's only running 8%. I can't sell a 8% copper concentrate very easily. Maybe I could in this market, but it's a bad example. Probably zinc. Zinc below 40%, a zinc concentrate below 40% is not saleable. Okay, very unlikely. Unless you can blend it with something else. And then you'll be taken to the cleaners by whoever does that blending. So I think you've got to be careful about that and you've got to read that part of it. So what type of concentrate is being produced, if it's a flotation concentrate, or if it's a doré or a cyanide process and a precious metal situation. Are there any things that will give you a red flag in terms of refractory? And you'll hear the word refractory ore, which just means it's harder to recover something out of it. An ore can be refractory because it is in a sulfide form, so you have to break that sulfur bond, which means you have to roast the ore first before you can leach it with cyanide. So maybe we're better just to produce a concentrate and give it to someone else to do, rather than building a roaster on site, which is not done very often at all these days. Or maybe look at bio-oxidation or bio-leaching, or maybe pressure oxidation. These methods of processing, people talk about it, but they're hard to do. Operating a bio-leach plant is not easy. There's all kinds of snags and issues you've got to get around in operating one of those. And so when they mention it, I'm always a little bit nervous if it comes up, right? It can work, but it's a risk to be considered. Yeah. And then, looking at refractory ore, if they say the ore is refractory and they can get a 90% recovery, then they're doing miracles, because a refractory ore probably only has 50 to 80% recovery, depending on what is wrong with it. It could be just something simple, like there's a lot of carbon near the gold, carbon in the rock or surrounding the gold vein. I've seen it in West Africa, where we had a graphitic phyllite next to the ore body, in the hanging wall of the ore body. And no matter how hard we tried to mine it, we always got graphitic phyllite mixed with the ore, because it was a soft, shaly stuff. It made a lot of issues for us. And the graphite, or the carbon, is naturally, it absorbs the gold. And in your carbon and leach process, if you're using carbon and leach, or carbon and pulp cyanide process, to using carbon to recover your gold through cyanide, you lose that because it's too fine. It goes straight through tailings, and so you don't get the recovery. And so you got to know these things. And so I'd recommend to your listeners to read up about it. Read what they say and then read up about that type of deposit and the problems encountered, if you can. And otherwise, ask people, online and Twitter. Mining Twitter is pretty good, actually. There's some pretty smart people out there. They'll tell you if something's good or not pretty quickly if they know it.
I'm trying to find it right now, but Lobo Tigre has a cheat sheet, I believe, for metallurgy that I remember reading a while back, where he goes over the different recovery methods and whatnot. He's at
Yeah.
independentspeculator.com, not paid to say this or whatever, but I just remember that was a good resource that he had there. So if you go into the website, there's magnifying glass that you can use to look for stuff. So probably there that you can find it. I cannot find it right now to give the exact title, but it's on there. And I know that's a
Whose
good resource.
website?
Independentspeculator.com. That's Lobo Tigre's website. He's got some good, he definitely has a couple of good articles on there about pre-feasibility and stuff like that, talking about metallurgy and
Yeah.
recoveries and stuff like that.
Yeah.
Very important as well. Neil, what are the most widely known kind of manipulation tactics when companies put out a resource? What do they use? Like, I don't know, optical illusions maybe. I mean, when I open up a news release, even if it's only drill results, actually, even if it's not an MRE, I'm generally drawn to the images. I want to go and look at the images, the cross sections, the long sections, and whatnot. And there's stuff like smoothing, white searches, no capping, and so on and so forth. Just optical tricks, essentially, that companies use. What's the worst one that you see out there?
Not so much in mineral resource estimates because, as again, it's the independent guys putting them together, and they are doing it independently, right? Um, so look at who's putting together the resource. If they're a reputable firm and have done good work for other companies, that's always a plus. I actually look at who writes the reports as well. But to get back to your question, I think press releases are much more easily manipulated, especially drill hole results. People neglect to mention, well, they have to mention true width or drilled width for one. That's the one that everyone forgets about. You know, you've got to correct when you go through a tabular deposit at an angle, you've got to correct for the true width. So people tend to say, I drilled 90 meters at 15 gram per ton gold, but if you drill it down the length of a tabular ore body, it seems very thick, but it's actually not. It's only 1 meter wide. That would be like the worst case, and I've seen that. What I also really don't enjoy is the way press releases for drill results are put out. They always talk about an intersection, and then they include the high grade part of the intersection in there in 3 lines. So they have from 9 to 20 meters, including 9 to 10, 9 to 20 meters is running at let's say 5 gram per ton, but from 9 to 10 meters, it's running at 15 grams a ton. Okay.
Mm.
And so if you work out what the rest is worth, the 10 to 20 meters is worth virtually nothing versus that 1 meter. All right. And I think that's where people get caught. They get caught on these supposedly big intersections, but they're not.
Mm.
Time and time again, I've seen that. Okay. So I think that's the biggest one you got to be careful of. I prefer to see companies that put out the full tables in the end of their press release. Makes for a very long press release and a lot of reading, but in that regard, I'll say the way the Australians do it's pretty good because they have to put out the collar. I think they have to put out the collar positions and the downhole distances and everything in there, and the inclination and the depth. So you can take that data and you can put it into Excel and create a database. And then if you have some software, you can actually load up drill holes and actually get to turn it around in 3D and see what's actually going on. There's a couple of people on Twitter who do that. I do that if I get the chance, if I'm interested in a project.
Mm.
So yeah, that's one I think that people like to manipulate. Also, people like to use channel sampling results or grab sample results. I mean, a grab sample is a spot sample. It doesn't represent very much at all. I could take another grab right next to it, and it could be nothing in it.
Yeah.
So it's nice that you have a good result in a grab sample, but it's a meaningless number. All right. Let's see what the thing comes out if we drill it, or if we actually go and put a tunnel into it. What's the average grade of that? It's not going to be anything close to what the grab sample is.
Yeah.
And then you've got to think of the nuggety effect of a lot of these deposits, especially precious metals. Um, you can get drill holes. I once saw a drill hole that was 1.5 kilos of gold per ton. Okay, over 1.5 meters. The grade was so high they stole the core.
Mm.
Someone stole the core. It was in
Yeah.
Zimbabwe. Okay, so we couldn't actually confirm that grade.
Mm.
Um, but can I use that grade to now assume that there's a massive thing? No, you have to drill another hole because you can actually hit a nugget and that'll spike your grade tremendously. So when I see very high grade deposits, I get nervous unless there's a lot of high grades everywhere. If it's just a few, like three or four out of 20 samples, say, or assay results, I will tend to cap those down to something that I think will be perhaps, you know, perhaps a little bit more meaningful. Because to assume the high grade, unless it's like all your hits are really high grade, then you've got to look at the sampling. Is the sampling, QA/QC good? We all remember what happened at BX, or maybe we don't. I don't know. 1997. Okay, BX. They salted the samples, and that stuff still happens. Okay, but it doesn't happen as ubiquitously as it used to. And that's why they have these reporting standards now. When you put out results, you have to show that you've done quality control and quality assurance
What do you
on
mean
your.
that still happens? Where do you? I would have absolutely assumed it does not happen anymore. Like I'm not even kidding.
Yeah. Well, I guess some of the individuals I speak to might not be the same that put out issue reports for public companies, but I've seen that, okay, where
That's
people, I
wild.
mean, people will tell you, they'll tell you crazy stuff.
Hmm.
And the less drilling there is on something, especially with a public company, that's why you've got to be careful. That on the one hand, you've got to be very careful of historical numbers in that regard. But on the other hand, if you've got a company that doesn't have much drilling and all they talk about is grab samples, you might as well be. I could be, I scratched my ring as I took the sample. Oh, wow, the grade's a lot higher. You know, there's no QAQC in a grab sample. Okay, because by the nature of the fact, it's a grab sample. So I'm not very impressed by grab samples at all. Drill hole results, they have to, in their published under public issue, they have to talk about the QAQC as well.
Hmm.
And that's to, you know, but it's road language. And I'm sure people have written stuff that not true. So take it, and that's where it helps. If you have more information, it's less likely for it to be uh, misreported. You can have a competent person as a junior company who works for the company writing the disclaimer at the bottom of the KOQC was done when you put out draw results. But when you do the MRE, it's independent. Those people are obliged to go and check, are the samples really being taken correctly? Is anyone adding any gold to the sample before it goes in? And that's why we do QA/QC. Okay. And so when it gets to MRE, now I've got a little bit more assuredness that there's at least something that's probably there.
Yeah.
Okay. Does that make sense? I don't know if I'm.
I think it does, but I think it's something that goes like you seem to be, put in a big importance on QA QC, whereas like most retail investors, and now I'm talking just for myself, really, that's something that you'd quickly go and ignore, right? It's just something at the bottom of a
Yeah,
news release, and it's just
yeah.
there. And you do you really read it?
Reading it doesn't help, right?
Yeah,
It, uh, you can put whatever you like in there, but that's why I say bear that in mind. Okay, unless it's an independent person signing over in that press release, it could be skewed. But we know with further down the road, no one's going to. I don't think anyone's going to buy. Well, I certainly wouldn't buy a company that's got one really stellar draw hole, unless I've got a little bit more information. Okay, and so do more drilling. And if they're all stellar drill holes, you're going to be found to be a fraud if you're lying, right?
yeah.
Very quickly. Um, so a lot of that's been removed, but there's still people who promote like crazy, and that's where the grab samples. When I see grab samples, I glaze over right over.
Hmm.
Drill hole results a little bit better, but if there's only a couple drill hole results, same thing. All right. Wait until they've got a decent, 15 drill holes, 25 drill holes, 100 drill holes, 300 drill, 1,000 drill holes. then now you've got something that's representative. Remember, that's what comes back to geostats as well, or you drill one hole in a resource, you don't know what the grade is. You've got to get something that represents best what is there. And even that's an inexact science. Even then with people have got it wrong. We've seen like the classic Madsen mine we were talking about a bit earlier. Um, it's been through too much changes of management before the current owners have it, and they seem to be doing okay so far. But it's one that I watch with interest because that was a highly nuggety, highly variable ore body. And there's been many cases like this, not just this, I'm just using this as an example where people have made big decisions, financial decisions based on assumptions that were wrong because what they drilled was not representative, or what they thought they drilled and they modeled was not representative of what was actually there.
Mm-hmm.
And that's where the specialist comes in, and even with that, you can still get it wrong, right? So, so that's inherent risk that's there. So when you talk to me about what about people spiking numbers or spiking data sets and stuff like that, that's just another risk on top of it, really, right? There's already risk with the thing, even if none of that is happening.
Yeah, that's I think that a lot of what you're telling me here comes down to kind of having experience with these things and having
Yeah.
seen all of these things, not go well, essentially. Which makes it harder, for someone like I even have been thinking about it and kind of wanted to talk to you about this as well is can I be ahead of the herd and kind of do my own resource calcs on the back of an envelope? That old formula, grade by volume by density, and then you apply a discount factor to it and then go on from there. Or is that a fool's game? How do you see that?
No, it's not a fool's game, but do it with your eyes wide open and acknowledge, even I acknowledge I don't necessarily know all the answers. And sometimes I make mistakes, even with my experience looking at things. Okay. Um, so bear that in mind, but I definitely would encourage people to work it out. If you think, especially when it comes to an exploration thing, if you can see some kind of structure there that you've seen somewhere before or a similar deposit and you think it's like that, that's good. You can use that as to assume, well, maybe this is what it is. And with these 2 or 3 drill holes that have been reported, I've got something really good here. But what does that really mean? I've got to go and take those 4 drill hole results. I take drill hole results and I do a mean on those drill hole results. Okay. Over the width that they think that they've reported. And I check that it's a true width. And say, okay, so those drill holes, this drill hole is 50 meters. The clump of drill holes is sort of over maybe, let's say 200 meters width in an area of 200 meters. So it's 200 meters long. And I'm averaging, let's say, a 5 meter wide ore body. So it's 200 times 5. Now I'm going to project how deep is the deepest hole, how deep is the shallowest hole, are there surface trenches, are there grab samples on surface to show that continues. Okay. And that's where grab samples are useful, just to see, okay, there's continuity there. We don't know what the grade is. I won't use that grade, but let's use the drilling results, mean those drilling results, calculate the volume. Now you need to take a shot at the density. Most people, that's where we can go wrong. But the rule of thumb is if it's a very soft ground, choose 1.8 as a density, 1.8 ton per cubic meter. Most rocks are around about 2.7 tons per cubic meter. Unless there's iron or heavy metals in there, you can go with that assumption. So times by 2.7 times the volume, now I've got my tonnage, right? And if it's on a ton basis, if it's going to be an underground method, well, what method is it going to be? What's that cost for that method? And what is the processing cost going to be? If it's a small mine, the processing cost will be higher per ton than if it's a large mine. So I know these numbers, but you can find out this stuff. Okay, it's not that hard. There's lots of mines out there which have, they produce cost results for processing for that type of deposit. So you find that, use that cost, use the mining method that you think can be used for your mining costs, and then your administration cost. Don't forget to include corporate overhead expenses. And And plug that in there and see if the thing makes money.
Mm,
And if it does, great. Now you can see, okay, this is the potential. This is how big it needs to be for it to be worthwhile for me. All right. Um, I definitely think it's worth doing, and I encourage it. And if you're unsure, ask somebody. There are people out there who 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 will answer you if you're tenacious enough.
yeah.
So
I typically run, tell me if that's a good idea or not. I typically run three scenarios for me. So I do that calc and then I do, a positive case scenario. So that'd be about 80%. So I'd multiply by zero point 0.8. I do an average. So I put a zero point 0.5 and then I do what if I'm wrong scenario. So a zero point 0.2. So
yeah,
let's say I've come up with 2 million ounces. I do,
yeah,
a zero point 0.2 and then it comes out, oh, this is less than 500,000 ounces. Not really worth it for me in the worst case. That's kind of how I think about these things and essentially try to figure out if that really makes sense, if the valuation on the company makes sense.
I think that's exactly what you should do. And definitely, when you calculate the volume and the ounces in the ground, you should definitely discount those ounces because not all of them will be mined.
Yeah.
Okay. So, and then, unless of course you think this thing's huge and could be, could be really worthwhile.
Yeah. Yeah.
Yeah.
Is that something you typically do? Like, do you buy pre-MRE yourself? Like, if you see a company that's done a lot of drilling, like for your own portfolio?
No, I generally buy mines that are already in operation because I understand them better. And I buy them because of the business value. I don't buy them. And I'm obviously speculating a little bit on metal prices too, like everybody else. But I guess I'm old-fashioned that way. I actually look for companies that pay dividends if I can. And
Mm,
right now, I'm not holding any that pay big dividends, but I'm holding three, I think, that pay dividends. But I like big dividend payers, and there's not many miners out there that pay dividends or do buybacks.
yeah.
Um, so that's what I prefer to do. But I will buy a company if I know a company well that is an exploration stage, and I know the team.
Mm,
But for me, a lot depends on who's on the ground as well. I look at who's on the ground, what ton of experience they've got, and I always pick up the phone and talk to them first, if especially if it's a small operation, right, or a small company.
mhm. I suppose a lot of it comes down to understanding rocks in that case. And what's the thing about mining engineers and geologists kind of all the time going at it a little bit, going at it each other?
Yeah, it's just I guess it's just in our blood and our wiring, um, because we both need each other. I think that's the truth, but we don't want to admit it. A lot of the questions you've asked me today really should be answered by a geologist.
Hmm.
Okay, so I'm giving you a mining engineer's opinion. I've done a lot of geology, so I guess I can I can answer those questions, but bear that in mind. Geologists would probably answer things a little bit differently to me.
Yeah.
And that's
That'd
also
be fine.
something to take into account when you ask me about. That's one of the reasons why I don't necessarily invest that much in exploration companies because it's not my business. Okay. My business is building and operating mines, um, not deciphering whether the resources, what could be. Okay. That's I leave for them. And it's a bit of a casino. For me, it's a bit of more of a casino than a mining company is. So
Yeah.
although I suppose there's plenty of arguments to be made that a mining company is more of a casino than an exploration play, but there you go. So
No crying in the casino. That should be the motto for no crying underground as well. I think I pulled you away from going underground today, didn't I?
yeah, you did. I'm able to go underground, but that's okay. Uh,
Well, do you not have Starlink underground?
no, we don't have Starlink underground. We do have networks, but not Starlink. Yeah,
We should do an interview once when you're underground. Maybe take me on a virtual tour. Show me what's going on there.
do that.
I'll let you do your thing now, though. You told me about an hour, and it's been almost an hour now. So thank you so much for doing this. What am I forgetting to ask you, though? What else is important to talk about here that you think I failed to bring up?
Haven't given it much thought, to be honest. I think I think the key takeaway should be know what the economic value is, the economic potential there is when you look at something. Okay. Um, do the sum, do the math, because it is, otherwise we're just dreaming, right? So try and associate, put an economic value to whatever it is you're looking at when you're looking at a exploration or a junior company. Um, because a lot of it is just the romance of exploration and mining. Okay, I really do think so, and there's a lot of failures out there, so it's very high risk. And so minimize the risk by putting the little science there is on it into it, so that you can minimize the tears.
Yeah. Yeah, well, you have to because there's no crying in the casino, as you said. It is for people listening. It's Neil Ringdahl on Twitter, and it's probably on your screen right now, so people can see it. And follow him on Twitter. Yeah, he puts out some really good stuff. We still have to do that episode on underground mining. Actually, I was just reminded of it from your you did a thread on it not too long ago. What is it? Yeah, but 2 weeks ago or something, you did a mining 101, the economics of open pit versus underground mining. We'll turn that into a podcast one day as well because it was really good. But yeah, thank you so much for doing this, Neil. I really appreciate your time.
Thanks, Antonio.